You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Well, thanks everybody. Sorry we're running a little bit late getting started, but I thought, I think first start with some brief introductions. So as our host mentioned, my name is Walton Liles. I'm a principal at Blue Ridge Law and Policy. Previously worked on Capitol Hill for the House Financial Services Committee as a securities lawyer, and have been sort of on the consulting side for the last 10 years. So maybe turn to Ellen next.
Hi, I'm Greene. I'm a managing director of equities and options market structure at SIFMA. And at SIFMA, I also lead our efforts on the consolidated audit trail.
Good morning. My name is Jim Hall. I'm the executive director of government relations at OCC. I also lead a group of Washington representatives known as the U.S. Securities Markets Coalition that consists of CBOE, NYSE, and NASDAQ.
I'm Jim Toes, and I'm president and CEO of the Security Traders Association.
Well, maybe to start off, I thought it would be helpful, I guess since last conference, to maybe start with a little bit of retrospective before doing a forward-looking. So, Jim and Ellen, maybe you could start with sort of how the last year went in Washington on Capitol Hill and sort of level set there before we sort of move on to the sort of current issues of the day.
No, good. You go first.
We'll let Jim know.
Oh, I'm supposed to go first?
Or Jim Hall, do you want to start? Or?
Oh, Jim Hall, you go first.
The two Jims, I told them that
here.
this is going to be a problem.
Absolutely. Happy to start us off. Last Congress, there were, I'm sure that Ellen and Jim also have legislation they'd like to talk about, because there's no shortage of bills that may have potential unintended consequences in Washington, D.C. But the three pieces of legislation I'd like to talk about today, two are tax related, and one is related to a House Financial Services Committee legislation that was a result of the GameStop hearings that occurred in early 2021. Let's talk taxes first. There are two tax bills last Congress that were threats to our industry, mostly due to the fact that it would increase costs if they had been enacted into law for market participants. The first was the financial transaction tax. This isn't new to you. This has been around a long time, but this tax has a big revenue component to it, and it's a simple tax. It is essentially just imposes a tax on a financial transaction in the United States. There's been a couple bills that were introduced last Congress. One was led by Bernie Sanders of Vermont. The other one was from Brian Schatz in Hawaii. And both bills would have imposed like a penny tax on a financial transaction or half a cent. And it looks great because of the fact that it's all about volume. And so these taxes just, it's a huge amount of revenue that would go to the government. But this bill did not gain any legs last Congress, and there's a reason for that, because there's a strong bipartisan support for low-cost access to markets. And the financial transaction tax would increase costs for investors. Therefore, those bills did not get any legs because members of Congress want low-cost access, and as trading has gotten less expensive, we see commission-free trading and fees have dropped. Imposing a tax would go directly to the market participant and to the retail investor. So there was not a lot of traction for that. That doesn't mean that's going to not come back this Congress. It comes back pretty much every Congress, and it's been around for a long time. So we always keep an eye on that. But that legislation died on the vine last year. The second issue is a little bit more bespoke to the equity options markets, and that is the Modernization of Derivatives Tax Act, also known as MODA. And this legislation is basically was very harmful to the options markets should it have been enacted into law. It would impose a mark-to-market tax regime on derivatives contracts, including listed equity options, and would basically tax the unrealized gains on any options transaction. And this is an issue that is a little bit newer. It's only been around since 2013 when a Republican named Congressman Dave Camp from Michigan tried to include it in a larger financial tax title when they were doing comprehensive tax reform. It didn't make it then, but it was reintroduced by Senator Ron Wyden in 2017, and then it didn't gain any traction then, and it was reintroduced in 2021. So the coalition that I mentioned earlier, we did outreach to the Senate Finance Committee and the House Ways and Means Committee to argue that a mark-to-market tax regime for equity options is a disaster because it's too complicated. No one would be able to calculate those positions and the tax ramifications of that. And if that would lead, obviously, to an exit of market participants from options markets, which would have very bad implications for the underlying equities markets, due to the fact that you'd have higher volatility and less liquidity. And members of Congress found those arguments compelling. Lots of them have 401k accounts, like we all do. They're called thrift savings plans, and they know the difference when their C fund goes from X to Y dollar amount. So they found that that argument was compelling, and that also died on the vine. That's not to say, again, that may not come back next Congress, or this Congress, but it is. It did not get a lot of support. But it is something that we're always watching. You always have to watch tax issues. And then the final piece of legislation was in the House Financial Services Committee, and that was sponsored by Chair Maxine Waters, who's the chairwoman of the committee at the time. And this was not really a formal bill, it was a discussion draft. But this was a legacy from the GameStop hearings from January through April of 2021. And basically what it would do is it would impose restrictions on brokers offering a variety of incentives, as well as it would require brokers to have to disclose the aggregate trading losses of their clients over the last 6 months. And the reason that the Congresswoman put this bill together was in order to she was hoping to help potential investors be aware of the risks of options trading. And the bill didn't really accomplish that. And the coalition got together and we worked with the Financial Services Committee's members to kind of explain what the bill did and the potential unintended consequences of that legislation. And again, a lot of the members of Congress on the Financial Services Committee understood that, and that bill died on the vine as well. So 3 pieces of legislation that would have had some potentially severe impacts on our industry. None of them made it, and then we start again this year.
Jim, so, you touched on a bit in that last one on, I think, one bill that was sort of a response to GameStop. Ellen, I don't know sort of how you, from your perspective, saw sort of the GameStop fallout, the report that came out, legislation, sort of how did that wrap up last Congress from your perspective?
Sure. So back in June of 2022, the House Financial Services Subcommittee issued their GameStop report. It was a 138-page report that was really focused on what happened in that period that Jim was discussing in January 21, when we saw really a big influx of retail trading in a very concentrated number of symbols. The report was really designed to look at policy recommendations directed towards the SEC, FINRA, and DTCC, and they were focused on things like resiliency, stability, more transparency, and access to the markets. What I think is really notable is that while the report did focus a lot on risk management, capital, liquidity, and there were a number of recommendations included in there, what the report didn't focus on were any failures of our U.S. equity market structure. The markets worked well, the markets operated, there was a lot of volume, volatility, but nowhere really in that report or in the subsequent report that the SEC issued on GameStop did we see anything that would suggest our market structure was broken. So it was really kind of, I would say, not something that Congress was pushing. There were no recommendations similar to the Dodd-Frank mandate that directed the SEC to adopt all of these policies or to make these proposals. However, we did see the SEC really move forward and put out very, I think you could almost call things like the order competition rule, best execution. They're almost draconian on the impacts that they could have. And I think it's just, it's a little troubling to us that this was nothing that Congress directed the commission to do, but was something more that just came from the chair's office.
No, that's a great point. Yeah, I think it certainly, Congress has seemed to put that aside and is letting the SEC certainly, well, at least from the Democrat perspective, sort of run with it there. Jim Hall, I'll give last name.
Oh, I got one.
Yeah.
I didn't put it in the notes. Sorry. So just one thing. If you have one takeaway from the panel, it's that an enormous amount of money and time gets spent on just killing things in D.C., making sure that nothing happens. The one issue that we were focused on last year, again, this is not a new one. It comes up from time to time. But it is the SEC's funding model. All right, so just for those of you not aware, there's a thing called Section 31A fees. So the way the process goes is that the SEC goes before Congress, they ask for a certain amount of money, they get appropriated the money, the SEC then goes back into their building and they do a volume estimate, and then they put they attach a rate to the volumes, and they collect the money to self-fund themselves on it. The issue that we have with this is that the equity markets are funding the regulatory costs of all those responsibilities at the SEC, right? The fixed income, credit agencies, and now crypto. All right. So the most recent budget that the chairman is going to be putting forth in October of this year is a $2.4 billion budget. It's a 17% increase. A lot of the increase he is pointing to the cost of the SEC for regulating or looking into crypto. So this one is kind of coming to the front burner for us, for the foreseeable future. That it's at some point this is not an efficient pricing model. A lot of these fees get passed back to pension funds. For some of these pension funds, crypto is like a religion for them. And if they find out that they're the ones who are paying for crypto regulation on their equity trades, there's probably going to be a problem with that.
The last issue I also wanted to just touch upon here was exchange liability.
Yep.
Back in March of 2022, I was fortunate enough to testify before the House Financial Services Subcommittee on exchange liability. And, certainly we see a lot of the congressional priorities shift. We saw the elections come in 2022. The Republicans took control. So while this isn't an issue that we've been able to gain any momentum on, we do think it remains very important because a lot of the SEC proposals are going to push more order flow back to exchanges. As we heard the other day, the order competition rule would really require any retail orders that don't receive a midpoint execution to go into an exchange auction. Unfortunately, we know that there's risk associated with auctions. Everyone's familiar with the Facebook IPO, the recent issue that the New York Stock Exchange had when their auction didn't work for all symbols. So there is a lot of risk that broker-dealers face. And when we think about exchange immunity, it's a difficult topic because when broker-dealers have an issue with their customer, they're going to make their customer whole. If they want to keep that customer, they want to keep the order flow coming the next day. But the exchanges don't have those same requirements. And because of that limitation, there are a lot of times when the firms aren't paid out, the full $1 for $1. So we do think that this is an important issue to keep on the radar, especially as we do consider pushing more flow back to the exchanges. I don't know that we'll have the momentum in this Congress, but certainly something that we'll continue to be focused on.
Got it. Jim Hall, maybe as we turn to sort of the current landscape, and as Ellen mentioned, we had 2022 elections, Republicans take over the House, Chairman McHenry's there. Maybe you can sort of at least give a little perspective on some of the other sort of big picture items. Everybody's talking about debt ceiling right now, sort of macro issues and the sort of the current political landscape, and then also any thoughts on sort of how the Financial Services Committee is going to operate sort of differently under Chairman McHenry versus, we talked a little bit about how Chairwoman Waters and what her priorities were in our space. What is sort of the McHenry view of the world vis-a-vis Maxine Waters?
All right, we only have 25 minutes.
I know, you got to be quick.
So anyway, let's talk quickly about the macro issues, and then I'll jump into the committee. I thought yesterday the panel with Commissioner Mersinger, I don't know if any of you saw that, but they talked a lot about bipartisanship. And there is a lot of bipartisanship in Washington, and I'd like to kind of start off with that. Historically, there always has been, and there continues to be. It's just not on the front lines. It's not reported, and I agree with that. However, we had the 2022 elections, and we're in a new Congress. And there's still bipartisanship, but there's also some other issues. And there's three reasons for that. The first is the size of the majorities in the House of Representatives and the Senate are historically very low. In the House, you have the Republicans control the House of Representatives by 4 seats, and the Democrats control the Senate by 2 seats. You have divided government. And the term divided government, you picture, and this is all, we all know this, Republicans, Democrats, partisanship, they're all trying to get leverage or fighting. And that's true. But I think a new dynamic that has cropped up recently is intra-party factionalism. Yeah. And that is where we have 2 parties, but we really have 8 parties. On the Republican side, there are 5 caucuses, also known as the 5 families, and they consist of groups of members of Congress going from rather moderate members to very conservative members. And each of these groups have an agenda, and they have a focus, and they are trying to leverage their agenda to the larger group, which would be the party. And so they work very hard to try to outmaneuver each other, which makes intra-party agreement harder than it has been in the past. And you can see a little bit of this when they elected the speakership election for Kevin McCarthy. It took 15 ballots.
A little bit.
But that was an example of this kind of intra-party faction problems that we are seeing. Democrats have the same kind of problem. They only have 3 rural caucuses to deal with. And that was, example of that was last Congress when they were trying to pass the Build Back Better Act, as well as infrastructure legislation and other priorities on their agenda. You had progressives versus what we call like New Dems, and they couldn't agree on that agenda. And each caucus was trying to get a little bit of leverage to put their agenda first, and that would then be the prevailing argument. So that is this factionalization, the small majorities, and finally the presidential election in 2024. We're seeing that sun rise again, and unfortunately, that's going to have an impact also on how governing is done in Washington. On the Democratic side, the Democrats are in the Senate especially are looking to try to shore up and use the communication messaging of President Biden. They're also trying to push President Biden's agenda. And on the Republican side, in the House of Representatives, there's obviously former President Donald Trump, that there's probably going to be other people that are going to enter the presidential field, so it could be a wide field. So Speaker McCarthy is having to kind of dance around the policy issues so that he can take into account where he thinks the presidential nomination process is going to go next year. So you have those 3, the majority, the intra-party factional issues, and the presidential election kind of weighing on the bigger kind of macro issues that we're going to see this year. And that's the debt ceiling, as Walton mentioned. And there's also China. That's another big issue. And then finally, funding the federal government for fiscal year 24. We can start with the debt ceiling. That is obviously that's on top of mind of everyone here. And there's really two, I would argue that to kind of read how this is going to go, you have to look at two different negotiations. There's the public negotiation, and then there's the private negotiation. The public negotiation started off literally on Wednesday when Speaker McCarthy and his caucus passed his offer to increase the debt ceiling with large spending cuts and accompanied other kind of policy provisions. And so he has now made that offer. This is where the Republicans stand in order to gain an increase in the debt ceiling. The Democrats have offered a clean debt ceiling increase without any policy provisions or spending cuts attached. So that's where we are right now. I would anticipate the Democrats will probably have to regroup and come up with an answer to what the Republicans have put forth in their policies. And then there's the private negotiations. And those negotiations are done behind closed doors, kind of stereotypical Washington, what you hear. But these are negotiations done by what they call the four corners, which you have the House Republican Democrat leaders, Senate Republican Democratic leaders, and the administration officials, as well as relevant committee chairmen, and they all have a discussion and they try to kind of iron out what is palatable to their respective interests and their constituents. So that has not begun yet, but I think it will soon. One of the big issues, in my opinion, why we haven't made more progress is there's not a definitive date yet on when the default date will happen. It hasn't been put on the calendar yet. The Treasury Secretary is, I think, analyzing the current situation. And until that date is put on there, whether it's June, July, September, I think it's going to be hard for the parties to kind of coalesce around this until they have a definitive date. So once they have that date, I think we're going to start to see more negotiation. But I do think this is going to be a drawn-out process that is going to go down probably to the wire as each party tries to get that leverage. And because it's so evenly divided, that's a big issue.
Jim Toes, can I ask you on debt ceiling, just sort of from, McCarthy came up to New York, obviously, and New York Stock Exchange gave his speech, and I think some people took that as like, Wall Street sort of has, I think there's the view in the conventional wisdom is Wall Street's like, oh, well, we always raise the debt ceiling, we're going to raise the debt ceiling, and I think, you've seen some messages from, I think, McCarthy and McHenry on sort of maybe not so fast. How is that sort of, what's your take on sort of how the market sees it playing out?
Let me just make two comments off Jim's remarks here. One is that level of bipartisanship. We did a series of meetings in March as we were getting ready for this April 19th event, and there was a fair amount of bipartisanship being expressed behind closed doors. And then when the lights and the cameras go on and questions get asked before a hearing, it's like, you didn't say that in the meeting, So
welcome to Washington.
Yeah, welcome to Washington, right? And listen, I think that Kevin McCarthy and I think others have really are doing a good job, kind of getting the message out how vulnerable we are, that we just can't keep raising the debt to the levels that we have been raising it through over the past couple of years. Yes, there's always been a disregard for deficit spending, but we have to admit the past couple of, however far you want to go back, the percentage of that debt spending has been historical highs. It seems like there's no nothing that can't be, just keep printing the money on it. And it is, we are vulnerable on this. And when our economy becomes vulnerable, it spills into how countries see us. We're not as that strong beacon, lighthouse of security. So, at some point it's going to have to, we will, have an impact on the markets. I'm not going to start talking about where I think the markets go from here, but it is. I'll say I feel good that the markets are kind of staying at these levels, and we're not seeing some type of an impact, and we'll see how the negotiations go.
So I know Jim we were going to try to get on China, but I may try to move us forward to talk a little bit about, and you brought it up, Jim Toes, with Mr. Chairman Gensler testified on April 19th, I believe it was. It's the longest SEC oversight hearing I can remember. Every single Republican asked a question, which I can never remember everyone staying. So maybe Ellen and Jim, from you all both engage a lot on the Hill with members on these SEC. Like, how do you, to your point, Jim, earlier on bipartisan behind closed doors, a little more partisan out there. What's the reaction when you meet with members on sort of an interest in what's going on, and then how they sort of view what the SEC is doing?
I had two takeaways on. I mean, one, there was a bipartisan criticism of the chair for his ambitious agenda and also how he's going about it. So that was encouraging to see, although I don't think it's really going to change how he behaves or anything that he does do on it. But I also think the other takeaway that we had on it was I think this particular House Financial Services Committee of this congressional class is probably one of the more talented as far as understanding financial services that we've seen in a long time. I mean, this committee is what they call a money committee. That is that if you get put on this committee, your ability to fundraise is a lot easier than if you're sitting on the Small Business Committee in Congress, right? So we tend to have around 60 congressional members year in and year out. That's 15% of all members in Congress, if you think about it. All right, I would say probably year in and year out, if we're lucky, we get like 9 that kind of understand how a stock is traded. This year, I would have to say that the number is probably around 15 or 20. And we were very happy to see, especially some of the newer members like Congressman Flood, Congressman Byron Donalds, the former financial advisor, very good. I would highly recommend that. Usually he's on TV. He sits on another committee, oversight. So when he's on TV, he's usually on talking about issues like that. But they can go deep on this. And I also think it's also the post-GameStop. Everybody that we've met with since GameStop, and I mean not just on the Hill, but at the SEC and FINRA, everybody knows somebody who has an app on their phone, and it's a lot easier starting a conversation with someone that has some type of hands-on experience with how our markets are operating today.
Yeah, no, I would just add on to that. We have, I think as you would expect, spent significant time on the Hill talking about issues like equity market structure, e-delivery, MiFID. And we really find a really wonderful reception there. I mean, using equities as an example, I spent 2 weeks in February. We probably did about 30 in-person meetings on both sides of the aisle. And certainly, as Jim alluded to, the level of sophistication and knowledge really varies. But at a minimum, each office was interested in learning about the proposals, learning about the impact to investors. And I think if we fast forward to the hearing, the current chair is very focused on digital assets. He's focused on climate disclosure. Yet we were able, through our efforts, to get him to talk about equity market structure. And I think something that was really interesting is I actually submitted into the formal record all of the recent academic studies which have been done, which really do support the quality of the U.S. markets that we have. But when we think about the hearing itself, last year, we saw a lot of the Democrats talk about the process that was occurring at the SEC. I think folks remember we had a flood of proposals that came out, and each of them had 30-day comment periods, which is absolutely insignificant given the breadth of the proposals and the impact that they would have. So what we've seen is really, I think, a switch on behalf of a lot of the Democrats where rather than just talking about the process, they're willing to get into the substance. We saw Congressman Foster recommend that 605 should be put forth as the first proposal to go forward. Let's see how the markets work. He had the sophistication to say, let's use CAT data to do that rather than having all of the brokers do that individually. So I think we really see a much higher level of understanding. We've also seen a number of letters come out of Congress to the SEC. We saw the Haggerty-Tillis letter from the Senate, Ann Wagner, Richie Torres from the Bronx submitting a letter to Gensler talking about maintaining access for young and minority investors. The Gottheimer, Huizinga letter. So there's really been a lot of congressional pressure coming into the commission, which I think is a really positive recognition of A, the quality of our markets that we have, and B, how detrimental some of these changes could be.
Yeah, it's maybe a great segue. So, I mean, I think the oversight, we've seen sort of unprecedented oversight, and I think we're going to continue to see it, certainly from the House on Chair Gensler's agenda. I guess, Jim Hall, maybe sort of, while oversight will be a big part of the sort of Capitol Hill's work, given divided government legislation is hard, near impossible on certain issues. What do you see? Are there areas where the House can move legislation in the financial services sector that you think can actually get enacted, or how do you see that landscape?
Absolutely. I think there's two areas specifically. Cryptocurrency digital assets, I think, is an issue that's going to gain a lot of traction in this Congress, and that is due to the fact that Chairman McHenry has a bipartisan experience with this. He's a very methodical. Patrick McHenry, the chairman of the House Financial Services Committee, is very methodical in his leadership, and he has a history of bipartisanship when it comes to digital assets. So last Congress, he worked very hard with former Chair Maxine Waters of California to try to develop a regulatory framework for stablecoins. Although they did not quite get there, they made a lot of progress. And since then, as he's taken over as leadership of the committee, he has introduced another stablecoin legislation. He has also worked to develop a subcommittee on digital assets, which is led by Chairman French Hill from Arkansas. And Mr. Hill is very knowledgeable on these issues, one of the big experts in Congress on this. And Bill Foster, a member of that committee, very knowledgeable on these issues. And so this subcommittee is very active right now on looking at how are we going to produce a digital asset regulatory framework. And so that committee's work is ongoing. But another area is the House Agriculture Committee is also involved in this. And the Agriculture Committee has jurisdiction over commodities in the U.S. House of Representatives and in the Senate, whereas the Financial Services Committee is on securities. So Chairman McHenry has reached out across to the Ag Committee with Chairman G.T. Thompson, and they are now working together to kind of set up guidelines and kind of guardrails as to what a potential digital asset regulatory market structure framework would look like. And so, in fact, there's going to be a joint hearing, I think in the early to mid-May, where the Ag Committee and the Financial Services Digital Asset Subcommittee are going to get together and have a joint hearing, which they don't do all that often anymore, to talk about these issues. And I think that Chairman McHenry really wants to get traction on this. And in the Senate, I think there's some bright spots. There's the Lummis-Gillibrand legislation. There's in the Senate Agriculture Committee, Senator Stabenow and Ranking Member Senator John Bozeman. They have a bill. So there's some sparks in the Senate as well. And I think I would not be surprised if this year Chairman McHenry in the House was able to put forward some sort of bill on a digital asset framework. I would not be surprised if he did that for market structure. And the only other thing I would bring up aside from digital assets is capital formation. That's an issue that celebrates a lot of wide bipartisan support in Congress. It's an issue that's been around a long time, starting with the Jobs Act that was put out and passed in 2012. Walton, you remember that very well.
Jim's old boss was the actual lead sponsor.
Yes, and it is. Enjoys a lot of bipartisan support, both in the House and the Senate, specifically because there's a lot of areas in which you can kind of do bespoke, narrow fixes to things that make a big difference, such as maybe changing the definition of accredited investor or doing something to enhance IPO or easing IPO, those types of issues. So I think that we will see a markup just happen in the Financial Services Committee, I believe yesterday, on about 20 capital market bills. A lot of those were bipartisan. I think that there will be probably a package that will pass out of the House. And that's something I think that there will be a lot of interest in the Senate on that issue. So those two issues I think will be, there's going to be a lot of traction on.
So, Jim, you want to add anything?
No, I just hope he's right. Because, listen, it's like the House Ag could, I know yesterday we spoke a little bit about the SEC and the CFTC and that relationship that they have, that maybe they could be working a little bit closer on things, but for reasons that they're not. That also trickles down to the House Financial Services Committee and the Ag Committee. They don't really have a history of I'm not saying it won't work this time, but they don't. I don't know if there's a long history of them being able to work together on something here too. And obviously, as we all know, the definition of a security versus a commodity is like the first big hurdle that they have to get over on this. So.
Yeah, and Jim did not mention what I view as sort of the biggest hurdle, which is the Senate Banking Committee, because you've got, I think, Senate Ag, House Financial Services, House Ag, all sort of interested in being productive legislators, and the Senate Banking Committee, some people can point to this number exactly, hasn't had a markup since, I think, December of 2017. Right. So like they're not exactly a great legislative body. And
they're the wild card in this whole digital asset discussion.
Yeah, that's nicer than obstacle, I guess. Well, maybe briefly before seeing if there are any questions, SEC, huge agenda, 50 rulemakings, 2 new commissioners. Obviously, I know there was a panel on the equity market structure proposals, and we've talked some about those because they're near and dear to all of our hearts. But Ellen and Jim, what else sort of at the SEC in Chair Gensler's agenda are sort of you engaging on? And what's the sort of, I feel like it's an interesting time with so many rulemakings, new commissioners, virtual, like how's the engagement going and what are you all focused on?
So I would say from a SIFMA perspective, we're really focused on all of the proposals that are impacting the capital markets. I think probably the vast majority of proposals that have come out, SIFMA has commented on them. I think notably the asset management group at SIFMA and SIFMA has submitted a lot of joint letters on this, which is a bit unusual, but again, just based on the impacts of some of these proposals, it seems that it's a very important strategic alliance when our views are that aligned. Personally, proposals related more to the equity and the options space that we've been working on, certainly the equity market structure proposals, we spent a lot of time talking about that earlier. Reg SCI, which could have a tremendous impact on a lot of the firms sitting in this room, trying to go through the proposal, figure out who those firms might be, trying to understand the definition. I think that's kind of a theme in a lot of these proposals that we've seen, is that they're not always clearly defined. An example of that would be the reproposal in a definition of an exchange, 3B-16. There's something called a communication protocol system, which they're looking to potentially capture as an exchange as they tinker with the definition of an exchange. But we look at the reproposal that came out a couple of weeks ago, and they don't define.
There's no definition of what
a communication protocol is. So, I think we continue to have a lot of questions, but, just overall, I think of all of my colleagues, in the capital markets group, in the prudential space, asset management, there's just really so many proposals coming out that from a trade association perspective, I don't think we've ever been busier. And getting back to the DC discussion, certainly our staff down on the Hill spends tremendous time talking to Congress about these issues.
Yeah, I would just say, listen, I'm happy that they're going to be back in the office 2 days every 2 weeks now, so that'll be helpful with the engagement. Listen, I think I think we had decent engagement with them before the proposals dropped. We haven't really had meaningful engagement with them since they've dropped. It is really hard to have any type of an engagement over a Zoom call on these issues. We also don't really know, how sincere he is on getting our input on this thing. He's been pretty public about saying how important, the public comments are in the final rulemaking design, but he's also publicly has stated that, because our industry is conflicted, that our opinions should either be undervalued or not valued at all on it. So it's been very frustrating with it. So we don't, and I got to tell you also where we do see it is really in the staff themselves and some of the meetings that we've had, and it hasn't been as many as SIFMA, the staff don't even ask questions. Like they're not even, it's almost like they're beaten down. Like it's like they're realizing that they're just going to do what the chairman wants, and the ability to kind of move him into a direction or to get him off an opinion or even just to tweak an opinion, it just is non-existent. And we see that both at the staff level, and I got to tell you, we even see it all the way up to the Democratic commissioners. When you read when they just go back to when they reopen the comment period on definition of an exchange, their remarks are weak. They're just outright weak, like they're just standing in line. And yet to hear one of them express their own opinion on anything since this chairman's been in the office.
On that positive
Besides,
note,
that's great.
Any questions? I think we got a couple minutes if there are any questions from the audience. I see one right there.
No.
I mean, that dynamic, right? I mean, of the SEC, CFTC, dual regulation, I think is out there in a number of areas, certainly in the digital asset space. I think that, I think Jim Toews made the point earlier, defining what's a commodity and a security, because that is the toughest question, there ends up being a default towards, well, what can we do without defining it, and sort of having both regulators have a seat at the table. To your point, I think a lot of people are skeptical on how that actually plays out, given that I think, Chair Gensler and right now, Chair Benham and Chair Gensler disagree on, whether Ether is a commodity or a security. Like, how does this actually play out? I think it's certainly an issue that people are cognizant of, and I think they're skeptical of creating a regime that is, I think they realize the benefits of having one regulator versus two. Jill.
About whether or not the chairman of the SEC actually has any priorities in these proposals that he's put out. His approach is typically, let's throw everything out there, bifurcate the opposition to these different proposals, and see what I can get through. Do you have any predictions on where his actual priorities lie in any of these things?
Yeah, I mean, like you said, like when you have 50 rules and they're all important, it's hard to figure out which one is really, really important, right? So I'd have to say no. I don't know. I mean, I don't know. I mean, I don't think, in some ways, I don't think he's as passionate on the ESG as maybe some of the people that put him in that seat want him to be. So that's one. But as far as like something that he really wants, I think he wants the whole buffet.
I agree with that. I mean, just based on meetings that we've had with the SEC, it seems very difficult to alter opinions. And I think having the Democratic majority, I think from where I sit, I think he's going to look to approve as many of these proposals as he can. I mean, maybe the only positive news here is that I think there's an expectation that perhaps he leaves at the end of 24. So the runway is getting a little shorter. We know he wants to look at fixed income. We know he's talked about options, the Crenshaw speech. So, it's a bit unknown what he'll get to, but in terms of what's out there, I think he's going to try and pass as many of these proposals as possible.
And I would agree. I think that Chair Gensler views all of his proposals as his children, and he loves them equally.
I think I'll be maybe less polite. I think he will do what keeps him in good graces with the progressives in the Senate that he views as his patrons, because the only thing what he cares most about is a bigger job later in life, and so that drives what his focus is the most, is what he thinks he needs to get done to stay in good favor with the Senator Warrens of the world.
Agree.
With that, we're flashing, so I think we're over.
Thank you.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.